Well, after a slow start to the year, global stock markets picked up towards the end of the first quarter to end higher, with March particularly strong. The MSCI World Index rose 5.9% in March, taking returns for the quarter to 2.7%. The JSE rose 3.9% over the quarter, with a 7.4% rise last month. So how did unit trusts perform? Well, to answer that question, I'm joined on the line from Swellendam by Laurie Buxton, Director at Plexus Group. Laurie, good afternoon.
Good afternoon, Stephen, and hello to the viewers.
Well, Laurie, the all-share up almost 4% in the first quarter, but of course, if you look across the different sectors, there was a very mixed picture. Financials doing well, industrials not quite as well, resources not great at all. Does that reflect in the performance of unit trusts as well?
It most certainly does, Stephen. The best performing sectors for the quarter, obviously, first was the financial sector, followed by real estate, which obviously also benefited from the lower interest rates towards the end of March. And then the third best sector was the smaller companies, which is also reflected in the performance of the mid and small caps, which were 8.7% and 5.5% respectively.
I mean, were you surprised by any of the moves that you saw in the markets, any of the sectors that perhaps outperformed?
No, not really any great surprises, Stephen. I think perhaps what is interesting is that we've had a quarter where we've seen the All Bond Index and the All Share Index both providing total returns of 4.5%. What we do tend to see in strong bull markets is that your equity funds tend to underperform your indices. And we've also seen bond funds underperform the All Bond Index. So I think it was a little bit of a surprise there. I think we did have a little bit of nervousness at the beginning of the quarter, especially as far as the equity managers are concerned, where they were perhaps a little bit underweight equities versus not benchmarks necessarily, but just a little bit higher cash than they might tend to hold.
Well, why do you think we did see those equities and bonds moving in tandem with one another?
Well, I think it was a combination of more positive sentiment in global equity markets during March, especially as you said, and then also I think the surprise interest rate cut at the end of March by the Reserve Bank also surprised the markets, and bond rates fell across the yield curve.
And of course, you do make the point in today's commentary that the best performing sectors were those that benefit from short-term interest rates. And do you think that'll be the picture as we continue into the year, because there is speculation that we could have more interest rate cuts?
Well, I think it's a 50-50 chance that we'll see any more interest rate cuts. Plexus's view is that the prospects for further declines in bond rates is rather limited. Also, as we have stated in our report, I think the biggest risk facing the global economy and global equity markets is perhaps a W-shaped recession, especially in Western countries. And should this materialize, let's hope it doesn't, then I think we could probably see a big sell-off in emerging market bonds. So at this stage, we don't think there's much prospect for good returns from bond funds going forward.
Well, what was also quite interesting, just in the best performance over the 3 months, as you said, financial, real estate doing quite well, smaller companies also doing quite well. And of course, we know that smaller companies have lagged the growth we've seen across the markets over the past year. Do you think that more attention is now being paid to those smaller companies now that we have really seen other companies run up so strongly?
Yes, I think there's definitely more attention being focused on smaller companies as well as mid-caps. One also does tend to see some mid-cap shares in the unit trust sector for smaller cap funds.
Just looking forward though, because we have seen a strong run up last year. Many analysts saying we weren't going to see a repeat of that this year. As we progress, I mean, is there still value in these markets? What should investors be looking for if they are looking at switching portfolios?
Well, Stephen, at this stage, in the short term, we believe that the prospects are still good. But I think at this stage it's very much a touch and go scenario, and we think that the equity markets are going to get a little bit more volatile going forward as we see some good news and perhaps some bad news coming through on the economic front as well as on the earnings front. But I think for the longer term we are still positive on prospects going forward. And the very short term, I think it's the mid-term picture that's a little bit more unclear. But at this stage, we would advise investors really not to move too far away from benchmark with equity exposure.
And of course, we did mention right at the beginning that resources really lagged the gains that we saw in industrials and financials. And we do know, we've seen those Chinese growth figures out this week, 11.9% growth in the first quarter. So China still hungry for resources. Do you think that we could see resources playing catch up as the year progresses?
Well, yes, the Chinese growth has been strong in the first quarter, but we have seen that the Chinese monetary authorities are trying to cool down their growth. So once again, I think the prospect for commodities and resources shares going forward is quite choppy.